Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. How do you invest in an on-again, off-again market? Donald Trump's tariffs, the threat of an all-out trade war and the risk of a US recession are giving investors whiplash. So how should they navigate markets when Wall Street and the ASX are rising and falling sharply, seemingly every other day? Remember, this is general information only. You should always seek professional advice before making investment decisions. Tim Hext runs the government bond portfolio at Pendal Group. Tim, welcome to Fear and Greed.
Thank you, Sean. Nice to be on.
How do you describe the first 50 days or so of Donald Trump in terms of markets, at least?
It has been chaos, you're right. You said the ups and downs. I think there's been more downs than ups in recent times. But look, yeah, it has gone from being sort of something where you look at things a more medium term to something where it's not only by the week or by the day, it's by the hour sometimes, his pronouncements. But I guess what people are trying to do is sift through them to find out the themes and where we may end up in 3 to 6 months' time, as opposed to just reacting to every single headline.
Okay, so on that, he talked about in the last 48 hours or so a potential of a US recession. That's probably overstating. He didn't say that. He just said that there'd be a hiccup or two on the way. What is the chance of a US recession?
It's still pretty low. I mean, you got to look at the starting point. You know, US has been growing at a very healthy 3% a year, contrasting with us down here where we've been managing around about 1% per year. So it's from a pretty good height. But you remember a recession, if you're being technical about it, you need 2 quarters of negative growth. That's not impossible. If the medicine they take to sort of achieve what they want to achieve medium term is strong enough, you can't rule it out. But it's still a very low probability. US government spending behind the scenes is still tracking along at a very strong pace, and that's going to keep going right throughout the year. He hasn't made any big cutbacks on government yet, other than obviously some of the very high-profile layoffs in the government job sector.
Okay. Is there a point? So why are markets so volatile at the moment? Is it trade wars?
Look, I think you've got to look at the starting point. You've got to keep that in mind. I mean, you hear US markets are off almost 10%, and that sounds very dramatic, but we're kind of back to where we were just before when the election campaign was on in September, October. Clearly after Trump got in and then sort of right up to his inauguration and slightly after, there was a real optimism there that he was going to, again, be very pro-business, all about tax cuts. It was going to sort of herald another surge in growth. And what he's revealed is that, I think those themes are still there in the background, but he's got an agenda near term, which is quite different. And the way I described it was, when you start looking at trade and you're sort of throwing sand into the wheels, you do really start to bring in question what may happen to growth in the near term. So I would characterize certainly equity market moves as the froth coming out, as opposed to grave concerns about where this is all heading, because we had that surge and that surge is now reversed, which is probably appropriate, particularly, and I'm not an equity person, but particularly given some very sort of what you might call optimistic, EPS levels, people factor in some pretty healthy earnings growth, which, was probably getting a bit ahead of itself.
It's almost like the correction we had to have, Tim.
Yeah, you're right. I mean, it's a little soft to sort of say that because markets do generally grind higher over time. But yeah, look, it always worries me when you get too far away from that sort of consistent sort of growth line, which is, if you think about the economy grows on average, it should grow around 2.5%. And that's in real terms. You get around about 2.5% inflation. You're looking at the economy in nominal terms growing on average 5% a year. And, obviously, if you've thrown a little bit of risk premium for equities, that's where you get your 6 or 7% per year style returns that people talk about through the cycle. So you've always got to get a little worried when you get 10, 15, 20% surges. That markets do get a little vulnerable at that point.
Stay with me, Tim. We'll be back in a moment. I'm speaking to Tim Hext from Pendal Group. Okay, so as an investor, how do you see through the noise? It's okay to say that we're kind of pulling back a little bit, but how should investors think about it? Not just equities, but your obviously government bonds and credit markets generally.
Well, I mean, for government bonds and for interest rates, which is really where I focus, you've got to keep your eyes on the main prize, and that is inflation. inflation is the most important thing. Growth matters, but ultimately inflation's the most important. And, despite obviously some concerns about there being some higher inflation near term, if tariffs were to really, gain a stronghold, inflation overall is pretty well behaved. In the US, it's somewhere, and in Australia, it's somewhere sort of around 3%. The US has been a little bit lower than that, but it's at a level where it's not high inflation anymore. I define high inflation as anything above 4%, and it's when you get that you start to see markets genuinely become unsettled, and that's what we saw in 2022. So how do you get high inflation? It's through supply side shocks. It's not really through the demand side, and I haven't seen any evidence of those. And with that in mind, I think inflation's pretty well contained. It does leave space for interest rates to fall further, and ultimately that's good news for the economy. So they're the sort of things you have to keep your eye on in the medium to longer term. Near term, obviously, other things will sort of push markets around.
Okay, in terms of the interest rate prognosis, both here and the US, you expect rate cuts this year?
Yes, I do. I mean, we've seen one here. The Reserve Bank was very quick to sort of hose down the possibility of any more. I think that's them in their super cautious mode they've had since poor old Phil Lowe got pillared all over the place for his predictions about where interest rates were going, or assurances, as many people heard them. So they're very cautious not to give any forward guidance. But if you think about inflation in Australia, it is now around about the 3% level, and it does look like it's going to remain there, or maybe even slightly lower. And with that in mind, we just don't need rates as high as they are. And I think, in Australia, there's still room for a couple more cuts this year. The US, a similar picture. I think there's room for a couple more. Now, I'm going ahead on the assumption that, the US economy and the Australian economy do okay this year. They don't have to do super well or super badly. They just need to do okay. And that creates a bit more room for inflation to come down.
So bringing all this together, it's kind of like don't panic in a sense. I mean, Donald Trump is making a lot of noise and bluster, but it's not as if we've fallen out of bed here or anything like that.
Well, you've got to look at what he's trying to do. And in amongst, and obviously all your listeners will have 100 different perspectives about the individual and about perhaps how he governs, et cetera, et cetera. But in the spirit of the art of the deal, he sort of causes a bit of chaos to try and get what he wants. And so far, in some areas, you've got to say he's been quite successful. I mean, the fact that Europe's now coming out talking about much higher defence spending on its own, not relying on the US, would be seen as a very good result for all the chaos he's caused over there. With the tariffs, clearly he's getting concessions on what he views as unfair deals, and he would describe it as levelling the playing field. And I really think it's the fact that, without getting into too much geopolitics, it's the fact that sort of the America always is seen as the responsible adult in the room, and he's kind of throwing it up in the air a bit, and it's making other people have to react. So, but I think in the bigger picture, he's not one to sort of upend the economy just to achieve some ideological aim. He will make sure that the economy doesn't collapse, as you put it. But look, if I look ahead at world growth over a medium to longer time frame, tariffs will pull that back a bit, but not enough to really upset things. So I would describe it as, yes, you're right, not panic, but I always encourage people to sort of keep an eye on where actual levels are, particularly when it comes to equities, even for bonds though. And when there's this too much optimism priced in, there's always plenty of room for corrections. And I would say we're probably through the majority of the correction. Maybe got a little bit more to go before we sort of settle down at some point in the middle of the year.
Just one final thing. We talk about the US and Australia a lot. We sort of forget Europe, but certainly in terms of equities, certainly outperformed the local market and Wall Street in 2025. Is Europe, only because it has to stand on its own 2 feet, we've got places like Germany spending huge amounts of money on rebuilding defence and things like that. Is there sort of, maybe we should take a little bit more notice of Europe going forward?
Look, I mean, you should always take notice of Europe.
True.
It's the second. I mean, Europe, China, and the US is pretty much the world economy. Obviously, maybe I should be a little bit more sympathetic to our UK and Japanese friends, but they are the big three. We all keep an eye on China, being Australia, obviously, and China is actually showing some encouraging signs against it. But really, I mean, the narrative which existed at the start of this year was a US exceptionalism narrative, and part of that is true because they have had stronger GDP, they've had more productivity than all the other regions by a significant margin. So there is some basis to that. But there was also kind of what they call a reflexivity of prices. Prices had done very well. People were looking for a reason for that, why US prices had done so well in terms of equities. And the exceptions and narrative fitted in quite well. And, what happens come January, the minute everyone thinks the US is kind of going to dominate the world forever, well, you get DeepSeek comes out, and then you get the new president comes in, and perhaps he's throwing a few more balls in the air than people thought. And suddenly, they do look slightly exceptional, but perhaps not as exceptional as they were. So anyone who's been in US equities will know that they've had an amazing run. And most of us have been left behind in its wake, including Australia and Europe. And this year so far is some of that correction. China's doing much better. Europe's doing better. Australia, not so well, but we're hanging in there.
Tim, you're making me feel better about the world.
I shouldn't do that as a bond guy.
That's not your job.
I generally leave the equity guys to tell you everything's fantastic and going to be fantastic. But yeah, look, I think you do have to keep some perspective about, what the US president's sort of medium to long-term gain is, as opposed to sort of announcement by announcement. Yeah.
Tim, thank you for talking to Fear and Greed.
Pleasure, Sean. Thank you.
That was Tim Hext, Head of Government Bond Strategies at Pendal Group. This is the Fear and Greed business interview. Remember, this is general information only, and you should seek professional advice before investing. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.